We have yet again another very important Tesla stock update for all Tesla stock investors, including Morgan Stanley's Adam Jonas. He has a new note out on Tesla stock today. Specifically, where are we going next, and what are the most important things for Tesla stock investors to know right now? We're going to cover that extensively in this video. Not to mention Adam Jonas, Cathie Woods is giving us a little bit more clarity on why she is reducing so much of her holding in Tesla stock and what she thinks is important next for Tesla. We're also going to get into that. Not to mention Lucid is joining the North American Charging Network, and yeah, Elon has some pretty funny things to say in that regard. And finally, we're going to get into some charts, and we're going to give you a technical breakdown on Tesla as well as the triple Qs. We're at a very important level that I think you should probably pay attention to the technicals over the next couple of days. Last but not least, we're going to get into your Tesla option activity here for the day today. Let's go ahead and break it all down for you here in this video. Hit that like button as well as subscribe to the channel because they are both free 99. If you guys would also like to support the channel, come trade with us live in real time. I do send out notifications every time I do make a trade. It's never financial advice, but it's a great place to be to learn, trade, grow your portfolios, and just get involved with the community. Link down below in the description for that one. Let's go ahead and jump into it. Let's actually start this video with what Cathie Woods said today about Tesla stock. And if you look at this article's title, it's very misleading. Cathie Wood has a blunt warning about Tesla stock over the coming months. But I think it should be mentioned before we get into what Cathie Woods actually said. Cathie Woods' actions have been very much selling Tesla stock. Back in June, the ARK Innovation ETF, the flagship fund, owned 3.5 million Tesla shares. About 12.5% of the entire ETF was in Tesla. But now, as of October 23rd, they only own 2.6 million shares, and it's only 8.9% of the ETF. That can somewhat be explained as well, the percentage drop, because some of her other top holdings have done very well recently. So that brings down the total percentage that the fund owns in Tesla. But that's only accounting for a little bit. They have still sold about 900,000 shares of Tesla. Cathie Woods told Bloomberg in regards to Tesla, quote, "It goes through wild swings. We will sell some and redeploy into stocks that have either been hit by some very short-term concerns or have underperformed significantly relative to Tesla for some other reason. But it's staying right up in the top 2 or 3 names of the portfolio because it is in the pole position for this opportunity," Woods said, referring again to robotaxis and autonomous driving. Quote, "We know that next year as they launch the Cybertruck, it's not going to be profitable," Woods said, referring to the scaling issues inherent to the production of the truck. "We are going to have to navigate through a volatile period. Whenever Tesla is setting up to do anything, there's usually a lot of controversy around it. So controversy around the Cybertruck, how well it will sell or how complicated it will be to scale." Musk himself did say on the last earnings call the Cybertruck is going to be a net drag on Tesla's business for probably the next 18 months or so. Cathie Woods then says, "I think a couple of things will happen. People, when they see the Cybertruck, I think people are going to get very excited about the next big leg for Tesla, the truck market." So overall, it seems to me she's still very bullish in Tesla. I don't think anything has really changed from Cathie Woods' perspective, but she thinks with the Cybertruck supposedly being a drag to Tesla's business over the next at least coming months at the bare minimum, there might be better places to deploy capital. I don't agree with that, what she's doing, that Roku and Coinbase are better buys than Tesla, but Cathie still bullish on Tesla stock. Although this article says she's giving us a blunt warning, it is a warning that we've already known about. Let's now get into a little bit of Tesla stock news before we jump into the note from Adam Jonas. Tesla's official X account shared or retweeted this post from Holmar's catalog of him playing Grand Theft Auto 5 on his Tesla Model S. And Tesla shared this and said, play Grand Theft Auto while doing Grand Theft Auto. And if I were to say so myself, I think the game runs better on the car than it even does on my computer. There's like literally zero lags, so that's pretty dang impressive if I say so myself. Mars Catalog did just tweet this. I'm unable to confirm this as of right now, but he says the first batch of Cybertruck configuration invites just went out. And Lucid has announced they will adopt Tesla's North American charging standard starting in 2025. Lucid customers will be able to access 15,000 Tesla superchargers in North America in 2025. Elon Musk shared this, reposted this to his X account and says, that must have been a bitter pill to swallow. Oh, the irony. Because if you guys don't know, Peter Rawlinson, he's the CEO of Lucid Motors. He used to work for Tesla way back when. On the note of charging deals, it looks like an unreleased Nissan Ariya Nismo EV was spotted charging at a Tesla supercharger. Estonia reported a whole 16 Tesla sales and 0.9% market share for October. The percentage year over year is actually pretty dang impressive. 1,400% growth year over year. Let's now get into the note out today from Adam Jonas. Adam Jonas titles this note, Tesla at 215. Where's the next price move? Quote, in our opinion, for Tesla stock to halt its slide and reestablish leadership, investors will need to see one or more of the following. Number one, stop missing numbers. Tesla's full year 2024 consensus non-GAAP EPS forecast stood at $7.30 12 months ago. This fell to $4.87 by June 2023 and currently stands at $3.94 today. To put this into a little bit of context, how this is affecting Tesla stock negatively, Tesla trades at 55 times forward 2024 PE multiples. So if you times 55 by what the expectation was 12 months ago of $7.30, with today's valuation of Tesla, you would have seen Tesla at $401.50 with the same valuation, the same multiple today, if the estimates 12 months ago were still the estimates. Tesla stock would be at almost a new all-time high. That's how much of an impact this has on Tesla's share price. Number two, execute the model expansion beyond the S, X, 3, and Y. The Cybertruck bar has been significantly lowered. While we continue to view the model as relatively insignificant within the grand scope of Tesla's future portfolio, we would not underestimate the impact of launch/ramp execution on sentiment. And this one could really go both ways. I would like to start with acknowledging the fact that Elon said those things on the Cybertruck he did on the earnings call, basically saying it's going to take 18 months at least before we see any positive impact to Tesla numbers, to Tesla's margins, to Tesla's operating expenses. Due to the Cybertruck, that lowered the bar. So what if it only took 12 months now? That's great news. What if it only took 6 months? That's great news, and that at this point is not priced in. The second part of what they say here could really go either way. If the ramp is not as good as we thought, that could be negative. If it's better than we think it's going to be, that's going to be positive. So they don't clearly state whether they think it's going to be good or bad. They just say there's going to be a lot of volatility around the ramp and the execution of the Cybertruck, which I do agree with that. Number 3, expand the total addressable market incrementally towards more capital light businesses. We believe Tesla's business model is at maximum capital intensity and maximum auto today. Over the next 6 to 12 months, we'd look for further evidence of the business model moving towards more capital light products, licensing, and software that have relevance beyond the auto market. Something I will note here that I've been wondering about recently. Remember 2 earnings ago, the earnings call, when Elon said they were in talks with a major OEM to license full self-driving? What happened with that? Are they still in talks? Did those fall through? Are we going to get a licensing deal for FS driving coming over the near-term horizon? That would be a massive catalyst for Tesla stock that nobody is expecting. That is, I would argue, my opinion, 0% priced into Tesla stock. Even if it's $50 a month for the subscription, that is 0% priced in right now. So if you're buying Tesla stock, that could be a big upside catalyst really any time now. From now until the end of 2024, I think we get at least one deal to license FSD technology. And on that note, I would like to point out we're already seeing this with the charging infrastructure, but the charging infrastructure does not make nearly the amount as full self-driving does. So even if we get an announcement that Tesla will start licensing their FSD software in 2025, the markets are going to assign a lot more value to that today because the value in 2025 is going to be so much larger than the charging network. Charging network's great, but that's really just a door opener for full self-driving. And number 4, idiosyncratic narrative change. For Tesla to defend its current multiple, we believe the company must show a credible link to the AI theme through tangible products that drive improved customer experiences in autos and abroad. So what will the next price move be from here? We believe it will come down to whether or not Tesla is able to achieve one or more of the above. We believe investors will show a willingness to believe in the long-term total addressable market and profit potential of the company, but are unlikely to take further downward revisions in earnings and free cash flow forecast without cramming down the multiple. Now, this next part is gonna sound a little confusing, but we'll make it make a little bit of sense. It's very exciting. It says a closer look at Tesla's place in the 30/30 club. We filtered the S&P 500 for companies with over 30 billion of market cap trading on at least 30 times forward 2024 PEs. Excluding a few outliers, we landed on a subpopulation of 28 companies that made the list, which we charted on an XY scatter plot of 2-year revenue growth versus PE. The simple average PEG ratio, PE divided by 2-year growth, of this group of stocks stands at 3.9x versus Tesla at 2.3x. That basically means that Tesla, compared to the other companies trading at a 30 times PE, you might have the Trade Desk, for an example, trading at a 40 times PE, or just call it 30 times PE. That's growing revenues at 15%, whereas Tesla is expected to grow revenue, top line, 23.8% for the next 2 years. Tesla, out of all of these 28 different stocks that are over $30 billion market cap and trading higher than a 30 times PE multiple for 2024, Tesla is the fastest growing top line revenue company, and it's trading at a discount to the other 28 companies that fit this similar bill on the S&P 500. Having said that, The market appears to discount risks to how profitable this growth will be, as evidenced by the sharp 25% type decline in non-GAAP EPS despite nearly 20% revenue growth. This is the exciting part. Applying the group's 3.9x PEG average to Tesla would imply a Tesla share price very near our $380 price target. So taking the average PEG ratio of stocks that are $30 billion market caps trading at forward PEs for 2024 of 30 or more, just for Tesla to be at a similar valuation of those companies would put you at about $380 per share. Morgan Stanley says, in our opinion, for the market to begin paying a higher price for Tesla's growth, the company must demonstrate earnings resiliency and growth once again. Adam Jonas says, while Tesla may have achieved its iPhone moment, it has yet to reach the App Store moment, which is critical to unlocking high margin, high multiple, highly recurring revenue. They say, while much attention is understandably paid to the growth of Tesla's annual unit deliveries, we are infrequently asked about the growth of Tesla's install base, monthly active users. This is their forecast of basically cars out on the road, and you go from where we are now at like 5 million or so to 2040 at about 120 million. That's a lot. They think by 2030, we're going to be approaching about 50 million vehicles out there on the road. Well, technically 34 million units out on the road by 2030. So this means, just as simply put, the more vehicles you have out on the road, the more FSD you can sell, the more recurring revenue services that you will sell, not to mention actually servicing the Teslas and whatever else Tesla plans to do down the line. The more vehicles out on the road, the more important metric for Tesla will become the monthly active users, the subscription revenue, not if Tesla sells 430,000 vehicles or 450,000 vehicles every quarter. Morgan Stanley says, we remain overweight on Tesla with a $380 price target and a bull and bear case of $550 per share and $120 per share. Last but not least, they put this in Exhibit 5, Tesla's future, regularly recurring asset-light businesses in a $10 trillion total addressable market. Tesla today, they say the auto business is worth about $1 to $2 trillion. And that's just where Tesla is today. And it's capital intensive, right? It does take a lot of money. Tesla's growing their business, building factories, things of that nature. But they say down the line, that's where you get into a $10 trillion plus opportunity with recurring revenue, SaaS, software as a service, asset light, and beyond autos, your robots, your FSD even. That technology, the neural nets, can be applied to potentially so many other things as well. If you have a dojo, let's say, training FSD, you could program a dojo to train something else based on neural nets. So the opportunity is endless, and that's basically what Adam Jonas is saying here in this slide. As far as the next move for Tesla stock in the short term, this article from Reuters says Wall Street extends winning streak, eyes Fed speakers, and Treasury auctions. That's really it for this week. We do have the Michigan Consumer Sentiment Survey coming out on Friday, but tomorrow you're going to have a few Fed speakers. You really want to pay attention to the voting speakers. As you can see here, the voters will hear from this week. Fed Jerome Powell on Wednesday. He also speaks on Thursday, but if he's going to say something that the markets are going to pay attention to, it's probably going to happen Wednesday. But you also get John Williams and Dallas Fed President Lori Logan. Fed Williams does speak tomorrow at 1 p.m. and Fed Logan speaks at 2:30 p.m. tomorrow. So the voters from the Fed are the ones that are really going to hold the weight. You have Fed Jeffrey that speaks at 10:50 a.m. tomorrow, Fed Barr that speaks at 10:15, and Fed Waller that speaks at 11 a.m. But that's probably not going to be a huge catalyst for our markets, as long as they don't say anything that is super different from what we heard from Susan Collins today, or Fed Jerome Powell on Wednesday, or Bostic last Friday. We've all heard the Fed speakers. They've turned very dovish as of lately. It almost makes you wonder if there's some kind of crisis going on under the surface, since Citibank is about to announce, presumably, they're going to lay off about 10% of their total workforce. And even JP Morgan said today, don't expect this stock market rally to last, that it's unsustainable. Quote, we note seasonals are typically supportive at this time of the year, and the likely peak in bond yields in the short term is also supportive, but this might not lead to a sustained bounce. And they also go on to say how a policy mistake from the Fed could be coming. This comes about 2 weeks after Jamie Dimon is selling JP Morgan stock for the first time in his 18-year tenure at JP Morgan. Something sure seems like is happening under the surface. We just don't know about it yet. If we take a look at Tesla option activity today, we had 637 orders totaling $983.92 million with a positive order value of 26%. This is actually the first day in quite a while where you've been less than $1 billion worth of option activity. So it looks like some people just took today as kind of a breather to see what is coming next for our markets. Again, those treasury auctions, they're really going to start ramping up this week. If demand does not come in for those auctions, yields are going to rocket higher. Fed speakers, we don't know what's going to happen there. So positioning was a little light in Tesla today with a positive order value of 26%. It was one of the more bearish days that you have seen recently. But you want to be very careful betting against Tesla. Jim Cramer may have learned this the hard way. He now expects Tesla stock to rise to about $300 per share. He said that this morning. Usually people kind of sell a stock in which Cramer endorses, but that didn't happen today. Once Cramer actually said this, Tesla stock started going higher. Tesla was down like 2% when Cramer made these statements, so I don't know if that trend will continue, people shorting what Jim Cramer says to buy, but it didn't happen today. Maybe he knows something that we do not yet. Because after all, just a couple of days ago, Jim Cramer was saying to stay away from Tesla. The UAW is coming for Tesla. Nobody's going to want to buy the Cybertruck. Literally last week he was saying that. And now he's saying Tesla stock's going to $300. Nonetheless, here's an interesting chart for you guys. It says the number of recessions starting in the year of the presidential cycle from 1929 through 2021. You have never seen a recession in year 3 of a presidential cycle. In year 1, you get the most recessions. 9 have happened in the first year a president took office. Second year, 1 has ever happened. And then in the fourth year, 5 have happened. So if we do head into a recession in 2024, then this 5 would turn into a 6, because this would be the fourth year of Joe Biden being president. If we were to see a recession, I believe that would be 2025, then you would see year 1 be a recession for whoever ultimately wins the presidency. But statistics, our statistics, and there's a pretty good chance we do head into recession in 2024, and yet add another one to year 4 and turn that to a 6. Jason Gopfer, he is sharing some of these charts, and I found it interesting that I figured I would bring to your attention. He says small options traders increased their put buying last week. 31% of total volume is among the highest ratios in 24 years. So while you did see a lot of calls get bought last week, you did see a lot of retail investors buying puts. Either retail is about to get smoked or, well, markets are going to fall and retail is going to be correct. I myself do not think the risk to reward makes sense being short in our markets or having puts on our markets. This is a chart of 1999 in purple, and this is the chart of 2023's NASDAQ 100. If this continues how it did in 1999, well, you could see some very big gains towards the end of this year. And if you guys just want my honest opinion, we just got all of our fear catalyst out of the way. It's going to be a while before we get another GDP report. Inflation comes out in the next 10 days or so, but as long as that's not super hot, it's not going to matter. We heard from Fed speakers, Fed Jerome Powell last week. He was dovish. We just got through earnings season. Things were fine there. I mean, there's not too much to actually give us that downside, in my personal opinion. Now, you have rallied a lot. Does that mean you could fall temporarily or trade sideways? Absolutely. But I'm not expecting us to fall back down to where we just were over the, past 3 or 4 weeks or so. If you look at the NASDAQ, the most important line is this downtrending line of resistance. It looks like you're finding resistance here over the past 2 days or so. Specifically today, it was a hard fight. We were above that at one point. We ended up closing just under, basically at this line. If you do get a break above, that's where you could really break out to the upside and make quite the run. I don't think we're going to make a huge run like that, but I don't think we're falling a lot. I think this is probably a range-bound market for a while. Same story with Tesla stock. Tesla was up big today, was down big today. Tesla did, for the most part, retrace back to the upside. That looks pretty dang good. You closed almost right on your 200-day moving average today. This 0.5% down move in after hours, taking you to $218 per share, is a little bit under your 200-day moving average, about $1 lower. So that's not exactly great, but it looks like you're trying very hard to hold support at that 200-day moving average. And as long as nothing gets bad in the markets, I do think Tesla has some catching up to do relative to what you have seen in the NASDAQ. I mean, look at this chart. That's a big retracement back to the upside. Tesla has retraced a little bit to the upside, but not nearly to the same extent as the NASDAQ or the IWM. So I do think that potentially sets you up for another move higher. And if you look at Tesla's RSI, that is at 43.80. So also under 50. So on the lower end there also. So that is going to do it for this video. If you guys would like to come join the conversation in the trading community, well, link down below in the description of this video. Come talk to us, come trade with us, come learn and grow with us. Link down below. Thank you for watching. Hit the like button and subscribe to the channel. Consider sharing this video with a friend, a group, a buddy, whoever you think needs to hear all of this information. Hopefully you guys like this in-depth video. If you did, let me know down below in the comment section. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.